The biggest of the big miners has unveiled Australia's biggest half-year profit. Soaring commodity prices have pumped up BHP Billiton's earnings for the last 6 months by more than 70%, prompting the company to announce it will give a $10 billion buyback to shareholders. They weren't impressed though, marking BHP shares down 1.5%. Andrew Robertson reports.
Rio Tinto last week, BHP Billiton this week. The big miners are rolling in cash.
We are very proud of a record set of results. The company is extremely well configured around enormous resource base to continue to grow.
And grow BHP has been doing. First half net profit soared by 72% to a record $10.5 billion as the company took advantage of high commodity prices to boost production. Revenue at the biggest division, iron ore, more than doubled. Coal for steel making was up nearly 50%, while base metals revenue rose 30%.
We've seen a major move and a major improvement in the economies, and that's certainly helped BHP on the pricing front.
It wasn't all plain sailing though. Like Rio Tinto, BHP has struggled to maximise the returns from its aluminium division.
For some reason, aluminium has not benefited from what we've seen in terms of economic growth, global economic growth to date. We do expect that perhaps going forward, and BHP maybe indicated a little bit that they expect aluminium to go stronger because they will be putting additional funding into that division.
Flush with cash though, BHP Billiton is giving more of it back to its shareholders. It's lifted its interim dividend by 10% to 46 cents a share and will more than double its share buyback program to $10 billion, an increase of $6 billion.
I think it's a starting point. I think the markets will be happy temporarily with that, but I think like Rio Tinto said last week, it's a starting point.
After 3 failed attempts at mega takeovers, Marius Kloppers has also flagged that future growth for now will come through expansion of existing businesses, with BHP planning to spend $80 billion on capital investment. But MineLife's Gavin Wendt has his doubts about how long that approach will last.
Marius Kloppers is certainly driven by the acquisition bug. You know, he came out of the Billiton side of things, and Brian Gilbertson, of course, was his mentor, and he was the first CEO of the merged BHP Billiton group. So I think since Marius arrived, he's always been looking for that killer deal, and no doubt he'll still be looking for that.
Gavin Wendt believes that search could be taking place here in Australia in the form of Woodside Petroleum, where Shell is selling out.
The advantage for BHP is that they share ownership of the North West Shelf gas project, and in the past when Shell made a bid for Woodside, it was not back on sort of sovereign risk issues. BHP being a largely Australian company shouldn't have similar problems.
BHP Billiton's huge profit has sparked renewed discussion about just how large the extra tax on the big miners' earnings should be. It coincides with claims the government's controversial and watered-down version of a super profits tax will raise billions of dollars less than expected.
We said at the time it would raise less revenue than expected by the former proposal. It does. There's nothing new in what is being said today.
The biggest downside for BHP Billiton at the moment is that production at its Queensland coal mines will be affected for the rest of the financial year because of the floods.